Welcome to the NGEN Markets Training session. Meanwhile, others are joining in. We will start with our session today. I hope my voice is audible to everyone and my screen is visible. So today's topic is going to be analyzing mutual funds on the basis of risk. So we are going to take a look into value at risk as a parameter. We will also take a look towards capture ratios. We will do some benchmarking and see up captures and down captures. And then third, we will also see the drawdowns analysis for the mutual funds. And then we can head over to the Q&A, where if you have any questions, we will try to answer them up and address them up. So you can either write it on the chat box or verbally, and we will try to address them. So I hope my screen is visible. If not, please let me know on the chat box so that we can take it forward. So here, as you can see, this is the NGEN Markets terminal. And to load any particular set of a mutual fund, you need to actually access it via two options. One is directly searching the funds from here. So let's say you go ahead and search one particular fund. So you can easily run an analytics on that fund just by searching it from here. So this is one way. Another way is that if you have a fund in your compare list, so or even in a screener, you can click on that fund and you can start your own tab directly. So for an example, we have added a couple of funds in the compare list. So all you can do is you can just click on this name of the fund, and it gets onboarded as a new tab where you can analyze multiple set of a fund. For an example, if I want to analyze Axis and Motilal Midcap, I can easily do that just clicking on them, and I can load as many tabs as possible. So that's one way. So here you can see that we have already added an analytics of Axis Midcap Fund. So now we can start analyzing the risk and see the parameters which we are going to be covering today. So I hope the screen is visible. And so let's take it forward from here. Here, as you can see in the performance tab of a fund, we have got value at risk, which is given here in the performance stats. So this is called as historical 95% VAR, which is called as value at risk. So historical is basically calculated on the basis of daily returns, historical daily returns of any particular set of a fund. So in this sense, this 95 is actually, conveying a confidence interval of 95%. And the entire, analogy here is that this data set, which you get here, negative 23.14, it denotes that there is a 5% probability, a 5% chance to have such a loss based on the historical daily returns since the start of the fund. So start of the fund, start date is given here. You can change the start date and you can easily see the value at risk being changed. So let's say we are considering the last 5 years ago. So all you need to do is click on the start date. You click on this 5 years ago, and you can easily, map in the historical value at risk since the last 5 years from 20th November 2017 till the current date. Now here within this, you can see there's a 5% chance, 100 minus 95, to have this loss, negative 23.26. Now you can change the confidence interval to see what is the probability. For an example, if I make it 98, 998, so now there is a 2% chance, 100 minus 98, to have this loss, negative 33.05. Similarly, I can make it 99. So it's like a worst case scenario that there's a 1% chance to have a loss of negative 46.75 vis-a-vis a benchmark, which is negative 60.29. So a benchmark given here is actually, you can change the benchmark from here. So we have given a benchmarking system here where you can even have a singular benchmark and even a custom benchmark, right? So custom benchmark is another topic anyway, but here what you can do is you can check it out. You can click on benchmark and you can see the asset versus the benchmark performance with the confidence interval which you choose to have. So here in this case, we have a confidence interval, and you can see that historical VAR shows us a lesser downside against the benchmark. Similarly, you can also see the annual volatility. It also denotes the risk, but the historical VAR shows you the downside risk, which actually gives you a probabilistic approach. That's basically it for the historical VAR. And here we also have the implied VAR. So implied VAR is also denoting the same thing, but with a different methodology. The methodology here is that this particular implied VAR is calculated on the basis of historical volatility. We have also given here, you can just, toggle around this question marks, which gives you what are what parameters, and it shows you the change occurring based on the historical volatility. Here also you can change the confidence interval to 99 to check what is the downside risk based on the historical volatility. And this is what the implied VAR denotes. So it's 1% chance to have a certain loss of negative 36.88. Now, these two are all models. There are different sets of value at risk model. Two are given here for a mutual fund analytics and even for a portfolio analytics. And you can gauge the risk based on either of those parameters. If you're looking towards the historical daily returns, then this is the parameter. If you're looking towards the historical volatility, then this implied value at risk will make more sense. Here we have given the comparisons against a benchmark, and you can even change the start date as I've shown you here. So even if you want to make a custom date, like for an example, you don't want 5 years, 3 years, or 7 years ago, you want something specific from 2016, you can go ahead and you click 3rd October 2016. You can see this is what the VAR is against a benchmark if I choose to have the worst case scenario, which is 99% confidence interval, right? So that's basically for the VAR. And according to the risk, as we are actually taking a look towards the relative stats, we are comparing it with the benchmark. We also have a relative stats column given here. So relative stats are pretty useful so that we can actually be able to understand, first, are we creating an alpha? And second, are we actually consistent against a benchmark? So whichever benchmark you have chosen. So in this case, we are taking a look towards Axis mid cap. Here, what you can do is you can see this annual return over benchmark, which is an annualized alpha, which is 1.94, whereas you can see the tracking error. So tracking error generally shows the divergence between the price behavior of a fund and the price behavior of the benchmark. So the more the tracking error is, the more different it is on the basis of performance against the benchmark, as it calculates the standard deviation difference between the daily return within the benchmark and also the asset, which is Axis Midcap. And it gives us an idea about the consistency against the benchmark. So higher the tracking error, the less consistent it is against the benchmark. And here you can also see the information ratio. Now let's compare the information tracking error against the two funds. So I'm just going to take two funds into consideration. One is Motilal Midcap here. So just a second. So I hope the screen is visible to everyone. And within the comparison, if we see the Motilal Midcap here, you can easily see the as we are keeping the benchmark same as Nifty Midcap 150, the tracking error is 9.21 against Axis Midcap, which is close to 7, and info ratio is actually higher. So info ratio is specifically the where you calculate the higher the information ratio, it indicates the desired level of consistency with the annual return over benchmark. So basically the calculation here is the annual return over benchmark divided by the tracking error gives an information ratio. So a better information ratio gives consistent approach against the benchmark, and it gives us an idea that if it is consistent or not. And these two parameters are also used actively in this index funds and ETFs, but you can also take it for a mutual fund within mid cap, small caps, and even large cap, where you're comparing it against a benchmark. Now the comparisons I've shown you, like one by one against Axis mid cap and Motilal Oswal mid cap, and I'm comparing information ratio and tracking error. You can easily do the comparisons for multiple fund in one tab in our compare section. So I'll just show you a gist of it here, that whenever you want to compare tracking error and information ratio, you can do that here in the main list itself. So whenever you are here in the main list and you have added the funds, all you need to do is head over to this tab where it shows the pink column. Here you just click the calculate button. So once you click the calculate button, it calculates in a particular sense all these funds against one particular benchmark. Here what you can do is you can choose a benchmark like Nifty Midcap 150, and then you can see the annualized excess return over benchmark, the beta, and the tracking error. So here in this case, the highest tracking error is by Motilal and then Axis. Now in this case, the start date is 2019, so you can change the start date if you want. So this start date is especially a minimum common period when you're considering a list. So you need to ensure that you're not having younger funds. So once you remove the younger funds from the list, you can easily see the tracking error and the information ratio against vis-a-vis a benchmark. So benchmark you can choose here. The start date you can have it here. So you can choose any particular start date here, and then you can easily compare the tracking error and the information ratio. So you can see many of the funds in the mid caps are having a negative information ratio. The reason behind it, they have a negative alpha. That's the reason they have a negative info ratio. So here you can easily see the info ratio and even the correlation with the benchmark. So it gets a very interesting when you're taking a look towards all the funds in a compare section and analyzing them within one single list. So that's basically it for the tracking error and info ratio. Let's head back to the fund analytics, where you can also see the capture ratios. Now the capture ratios are pretty useful, because what you can do is, as you know, we have selected a benchmark already as Nifty midcap 150 here from the change benchmark button. So here you can see the capture ratio. So this ratio is basically the ratio of the return of our asset and the benchmark in a monthly format. You can even see here, when you click on this I button, you can see the return of our asset, which is our fund, versus the benchmark, and the monthly return sets against the benchmark. So our capture ratios denotes when the benchmark was up, how has our fund performed in that particular month. So these are all up months of the benchmark. You can see all the positive months, and the return sets of our assets within that range. So you can see all the months in the up capture, especially the capture ratios in up capture. It should be more than 100. If it is less than 100, then we are not generating as much return when the benchmark was up. Whereas you can also see the down capture. So down capture, we have also given this I button to see the breakdown of the months. All you need to do is just click on it, and you can see that when the benchmark falls, when there's a down month in the benchmark return sets, you can see the asset is not having that much of a fall. So the negative returns are actually lesser, and you can see for every single month we have given the benchmark, we have given the breakdown of the asset and the benchmark for those particular months. Now, in this case, the down capture is suitably lesser than 100. So that's the reason, we are having a lesser return, lesser drawdown against a benchmark in a monthly domain. It gives us a particular idea that if we are choosing a benchmark, whatever outperformance we are having is definitely one of the contributing factor due to the down capture ratio. When the benchmark falls, we do not fall as much as the benchmark. So this is considering a fund which we are taking into the consideration. So that's basically it for the risk of historical and implied. And talking towards risk, we can also take a look towards what has happened in the last 10 years or last 7 years, and how we have recovered. To check that, you can go ahead and take a look towards drawdowns analysis. Now, drawdowns analysis is pretty useful, because it gives us an idea that if we are having a start date from 2016, let's take a look towards a bigger start date, a longer one, like let's say 2012. When we click on it, we can go ahead and click on the drawdowns and see that there are certain gray areas here. So these gray areas denotes the drawdowns. Basically, these are the losses, top losses which occurred in this portfolio, which is fund, right? And you can even zoom in one particular loss to check out the drawdown here. So let's say we are looking towards this COVID crisis. We had this drawdown in COVID, and the drawdown we had is actually denoted here, which is negative 29.44, which was the highest drawdown between the period of start date of 2012 till the current date. So here this gray area shows you the drawdown of the fund and the recovery period, which is given in the white. Now we have given a statistical way to actually give you a clear understanding of how, how many drawdowns have happened and what are the days to recover. So I will go through one by one. These are the top 10 losses which has happened in our fund, which gives us an idea that these are the losses and these are the start date of the drawdown period. So this is the start date. With this particular set of a start price, you can even go ahead and just scroll it up, and you can see the start date of the drawdown, and here you can see the end date of the drawdown. After the end price, we have the recovery. So recovery are these number of days. So every single losses what this fund has given, there is recovery period, and there is certain loss which has occurred in 2021 October. if, Whereas you can see it hasn't recovered yet, it's 70% still recovering. So that particular drawdown, you can even zoom in from here in the right side. It's a current drawdown going on. 2021 started in October, and now it's still recovering. Once it recover, it will give a days to recover, number of days to recover here, and the recovery date here. So drawdowns are pretty useful. You can even screenshot this up. There are a couple of ways you can screenshot this tab, and even the screenshot given here. But you can also access such kind of a table just by creating a PowerPoint report. Now, PowerPoint report is pretty useful. We have actually explored PowerPoint reports in portfolio analytics, but we have given an option to actually create a PowerPoint for any particular set of a fund. So here, let's say you want to create a PowerPoint report of this singular fund. It's kind of like a pitch book, pretty useful. All you can do is you click on it, and the PowerPoint gets generated. So just a second, once it gets generated, you can even see the tables of the drawdown, whereas you can analyze all those particular set of an analysis which we have taken a look towards, right? So that's pretty much it for the drawdowns analysis. It gives us an idea about what is the strength of the portfolio and how the portfolio has recovered when there was a drawdown in the system. Now here, as I hope everybody is able to see my screen for the PowerPoint which I am displaying right now. If not, please let me know in the chat box. So here, what you can do is you can easily see this is the report which is generated through NGEN, and this is a co-branded report, and you can see all the data sets with the holdings of the funds, with the overall asset allocation which is given here, also the breakdown of the sectors. We have given some figures of the sector ratings, and all the uh, change in the percentage, and this is the performance which we have explored today. So today we have explored the historical value at risk. So what in the 95% confidence interval, what are the risks? You can highlight them up. It's pretty useful. You can use it as per required for your own customization. And here we have given drawdowns. So drawdown, this is the table which I was talking about, and it's a pretty useful table because this table denotes what are the losses, how many losses have occurred, the top 10 losses, and how many days it took to recover for any particular set of a fund. So in this case, you can see there is a still ongoing recovery going on, in this particular set of a loss. So, I would definitely highlight this up for any particular set of, the portfolio. So this is pretty much it. It's editable. You can edit as many colors if you want. And this is also a rolling analysis. So rolling analysis gives us an idea that if you're rolling a 1 year period, 2 year period, and a 3 year period for any particular set of a fund, then what kind of a volatility you would have on that rolling returns. So that's another topic anyway, but this will be useful to understand the risk as well on a part if we are running rolling analysis for a 260-day period, 520 and 780 days period as well. So this is a drawdowns analysis, and this is how you can create a report. Another set of a report which you can easily create is this report, which is a seamless PDF reports. There's a 1-pager, 2-pager, and a 3-pager given here. So I'm just showing you that if you want some seamless reports, you can generate from here. And once you open this up, it includes everything which was there in the PowerPoint, but in a PDF format, which itself shows you all the what is the benchmark used, what is the ISIN code and everything for that particular fund, and the return sets and the analysis. So this is particularly the report, and also the drawdowns which we were exploring today, which shows you the drawdown details and rolling return details. So this report, I'll just highlight this up. I will just present this up in front of you. So this is a 4-pager PDF report for a detailed one, which shows you entire asset allocation, the performance chart, the performance versus SEBI classification, the peer analysis, and even the rolling return analysis. Whereas you can create a one pager and a two pager as well. So for a one pager, you need to click on this. A one pager will give you specific only one page detail, which is in a simplified form, only the performance and the stats and the holdings. So that's pretty much it when you're creating a PDF report for any particular set of a fund. And there are other things which you can also look towards, not on the basis of risk, but you can just take a look towards the peer analysis. Now, why peer analysis? Because a peer analysis will give you an idea that if I'm choosing Axis mid cap, and if I want to take a look towards the volatility of the SEBI classification average, which is given here. So SEBI classification average is for all the mid caps given here. And I can even, sort it on the basis of Sharpe's ratio and the volatility to see if others, if this fund is actually having better, a lesser volatility against a SEBI average or not. So this is given here. So you can take a look towards the volatility of the SEBI classification average and also the Sharpe's ratio. So initially the SEBI average of the Sharpe SEBI average is actually higher than the Axis mid cap. So you can take a look towards the funds which are beating the SEBI classification average, which will also include a younger fund, by the way. So you have to take a look towards funds which actually has more a younger, older start date. So that's basically it for the entire set of an analysis and for today's topic. So we can start ahead with our Q&A. So if you have any questions, you can either write it on the chat box or verbally, and we will try to answer them.
There's a question saying, what is the confidence interval? So, Omer, if you could just go to the, any VAR. Yeah. So basically, what you see here is the historical VAR. So when we look at this, we usually say there's a 5% chance of, this loss happening. So the remaining out of 100 is actually the confidence interval. So the 95 is what you type here. And 5% is the other side of the equation, basically saying that that's the chance of loss. So it just, it's just how it's termed, but effectively from when you're using it, this box, you have to type a number out of 100. Once you go below 80, 90, it doesn't make sense that much, because then you're just trying to guess what is a 50% probability of something happening. You just get a midpoint number or something like that. But generally speaking, here you should enter, 90 or above is what would give you meaningful answers. So for example, 99 confidence interval means that you're asking that what is the, what is the size of loss that has a 1% chance of happening. There's another question saying that you've observed some discrepancies in capture ratio. So if you could give us some more details here, what you find, found.
Yes, of course. Can you allow me to share my screen? Actually, I have taken some screenshots.
Sir, on this call, we won't be able to do it because there are a lot of people there. We can connect with you separately if you'd like. We can do that.
I would like to. Okay, I would like to tell you here.
Sure.
See, suppose this line is showing this outperformance. Okay. But sometimes what happens ki here up capture ratio is more, down capture ratio is less, but this graph is showing underperformance actually. So that is the discrepancy actually I have found in many of the schemes.
So this is basically cumulative outperformance, right, from the beginning, and plus up capture ratio will basically tell you what it's done during the months that the benchmark was positive. That doesn't imply outperformance. So you can't really use the capture ratios to imply whether or not it will outperform the benchmark, because capture ratio, the exact definition for capture ratio in this case, up capture ratio will be what did the asset do when the benchmark or whatever benchmark you've used is up above zero, and same for down. In fact, here you can see when we look at the breakdown, These are not all the months. You can see there's December, April, May, September. They're only showing the months where the benchmark is positive, and then showing what the fund in this case has done.
Yes.
Right. So, and when you look at the down capture ratio, you can see all the months where the benchmark is down and what the asset did. So I mean, there is no real there's no real kind of implication that you can make from capture ratios to say that our performance should be positive or negative.
But actually, the outperformance or underperformance, actually, that is the result of a cumulative this up capture and down capture. No? So this actually, because all the months, because actually I if you allow me to show my screen, then I'll be able to explain you actually. So what happens ki the up capture ratio, all the up capture ratio, this is the sum total of all up capture and down capture ratios, na? Hello.
Sorry, could you repeat the question, please?
This fund is showing up capture 84 and down capture 78. So this is the sum total of all capture ratio, was just the average of all these.
So that is, these individual numbers are not capture ratios, they are the returns.
Yes, okay.
So 84 is the capture ratio.
Yes.
The individual numbers that you see when we open up that box are the monthly return.
Okay.
So this, when you get 84, it just shows that this fund slightly underperforms the benchmark when the benchmark is up.
Okay.
So the capture ratios are not really used to check outperformance. It used to see or understand the relationship between the benchmark and the asset in terms of how the asset does when the benchmark is up and how the asset does when the benchmark is down. So for example, if we take an index fund, they should be closer to 100 than this equity fund, for example.
Can I? Okay, then will you open some particular schemes if I tell you?
Yeah, sure.
Yeah, just hold on for a moment. Can you open this Edelweiss equity savings?
Yes.
Growth. Yeah. Yeah.
Yes, sir.
This is the point actually I'm trying to raise. Here you can see the total overall capture ratio is 33 and down capture ratio is 21. Whereas the fund is actually this growth chart is showing negative performance.
Yes, sir.
And say underperformance.
Yes.
So why this anomaly? Actually, I'm just actually not able to.
Sir, it's not an anomaly. This actually makes sense. 33 means that it's below 100, right? So capture ratio when it's below 100, it means it will underperform.
Okay, okay.
So the 33 capture ratio does not imply positive performance. In fact, it implies bad performance.
Okay.
Because if it's over 100, that's good. It's below 100, that's bad.
But sometimes what happens ki if the up capture ratio is significantly higher than the down capture ratio, then I think cumulatively it should outperform.
So that is definitely not, I mean, it's not a property that is always true, right?
Yes.
Because it depends on the path that it's taken. So, you know, up capture minus down capture ratio does not imply positive difference, does not imply, you know, outperformance in this case.
Okay.
Or in any case for that matter.
Okay, then I'll have to look for some few more.
We can, if you want to look at this in detail, we can schedule another call with you and we can go through it as well.
Sure. I'll be up for that.
No problem. So we will arrange something for sure.
Thank you.
No problem.
Sir, in the same screen, the down capture when it is 21, it means on the downside it is very nicely capturing
Yes.
or it is protecting the fund, right? So that
Yes,
is also a good attribute.
That is, yes, ma'am.
So isn't that the attribute of a conservative fund? It has to be like that, right? So upside.
Generally speaking, yes, that's what you would expect. One really good website for looking through all this information is Investopedia. I'll just share you the link here.
Okay.
Where we'll just share the link here.
Sure.
Yeah, I've shared the link here, and this is in my opinion, this is the best place where it's really been explained clearly. Okay, and of course, if anybody wants to have more sessions, we can get them done offline. So there's another question saying, is it possible to get attribution analysis of any equity fund, performance deviation because of stock selection or weighted allocation? So yes, so we've had this question before. The biggest issue with this is this actually means that actually before we go there, America just go to asset allocation and just go to positions over time. In order to be able to determine how any stock contributed to the performance of a fund, we would need to know exactly what the fund manager has done, which stocks have bought and sold. Unfortunately, disclosures are only monthly by mutual funds. So what you see here is a monthly disclosure from the fund manager saying on 31st of May, we were long, whatever, 12.5%, this, that, etc. What happened in the middle, no one knows. What price they went in, what price they went out, no one knows. In fact, if you take these stocks, stock percentage holdings, and you calculate the profit and loss of this moving stock portfolio, that will 100% not match the performance of the fund. If you do this exercise separately, that blue line, which is the actual NAV, it will not match. And the reason for that is there are a lot of issues here, because the only information that is available to us from the fund managers is one monthly data point of what their holdings are. So in order for us to properly calculate attribution, we would have to get an idea of the underlying transactions of the mutual fund, which are not described. Now, we've seen some systems that provide attribution analysis. And in that case, all you have to do is if you add up the numbers, they won't ever match up the monthly return. In which case, what you end up with is basically incorrect information. So attribution analysis is possible if you have all of the underlying data, but for mutual funds with monthly disclosures, that's impossible. And that's the reason that we don't show this. Yes, please go ahead, sir.
So basically my question was, if there is a difference in the performance, whatever is explained by our calculation of attribution analysis, and there could be some component which is not explained by our calculation of attribution analysis. At least we can understand that there are certain transactions which have happened which are not being explained by our calculation of attribution analysis. And if such phenomena keeps on recurring, then one can be cautious about such funds. That is the only perspective.
Sir, I can tell you with 100% guarantee that no attribution analysis of any fund will ever match.
That's fair. I'm not disputing that, and theoretically it should not. For the right reason, as you mentioned, that there could be intra-month transactions as well.
So it's
But-
not just intra-month. Lot of funds are actually, they don't change their positions on a monthly basis. The other issue that happens is with the AUM changing, with new subscriptions come in, some of them increase their positions, which they should be doing, because otherwise your percentage allocation to that stock will change. Some of them don't increase their positions, in which case, as the AUM is growing, their position isn't growing. So the percentage holding actually changes on a daily basis. On top of that, there are other slippage issues which are very, very large. For example, when we look at the change here, if you go to asset allocation back, Umair, into the position over time, you just take one example, ICICI Bank stock. The difference between 1 month and the other month is 3.99% on 30th September, and then 4.16 on 31st October. This is, if we are going to use this underlying position to calculate attribution, that means we are making an assumption that this particular fund changed its position from 3.99 to 4.16 exactly on 31st October, which is definitely not the case. And on top of that, what price they entered in, and ICICI Bank is a pretty volatile stock. So what price they actually transacted in, no one knows. So whatever you are able to calculate using these numbers it's not that it will be incomplete, it's that it will be wrong. And that is the reason we don't calculate, because it's not like we get some idea. In our opinion, the idea that we get from those numbers will actually be incorrect. And that's the reason that we don't even delve into it.
So from that perspective, what could be better indicator which can show if some intra-month adjustments have happened, or some kind of short-term trading has happened, which is not supposed to be, and so on and so forth.
So the only thing we can do here is simple. You can do some guesswork, but at the end of the day, nobody really knows. Only the fund managers will know. This, for example, this attribution analysis, the people that can give us the correct attribution analysis is the fund house itself. If the AMC is doing attribution analysis, they will have the exact numbers because they have the accounts behind them. So, for example, here you go to overview. I don't know which fund this is, but go to overview. Axis mid cap. Okay, overview, and then scroll down all the way to the smallest positions. So sometimes you find these tiny little stocks, right? And you think, okay, why is it there? It can't be that they have a view on Aarti Industries, so they point 0.17. It's not like this is an algo fund. So then you have to speak to the fund manager, understand what this is. And obviously these trades are not happening in the last day of every month. I mean, sometimes something could happen, market is up, market is down. These guys are fund managers. They are not going to wait till the end of the month to execute. So the thing is, if you want to get an idea of how much money a fund manager has made by investing in ICICI stock, that question only the fund manager can answer with accuracy. We will not be able to. I mean, we can try, but as I said, the information it just is not there, right? Because all we're taking is monthly snapshots, and they might as well be at random. Instead of 31st October, if it was 20th of every month, you'll get a different answer, completely different answer, right? Now it just happens that we are getting it on the 31st. So that's the problem here, and here, I mean, for example, when I'm showing you the small positions, maybe there is a valid reason for that. Maybe there isn't. Again, this is just guesswork. We don't know. So these are questions that only the fund manager can answer. In terms of analysis, we can look at some things. For example, if we look at positions over time, and just go there again. Theoretically speaking, we have all the data. We can look at this historical portfolio changing over time, apply the stock price, and see what we get. Right? As I've said, we've done this many times, and it's 100% guarantee it's never going to match. In fact, lots of times, 1 month the fund is up, and the stock position change is implying that it should be down. Right? So you get that also. So this is not a good indicator of finding out. This data is not enough. to find out which stock they have made profits out of. The latest holdings are also 10 days old, 15 days old. So this is a problem now. The good thing is some of the mid-month disclosures have started coming out. So in that case, you can get a slightly better idea of how much they are really churning. And as I said, the AUM versus the AUM issue is also there, right? Here you can see ICICI is 4.16%, right? And mutual funds have daily liquidity, which means every day they could be getting crores of money in. But are they changing their position? So Umair, just change the percentage shares.
I got you.
Yeah, so here you see, sir, Cholamandal, 111.74, 111.7. So now we don't have wages showing only 0.74 in lakhs. Maybe in the last few decimals, you can see some changes, but the AUM has changed from 30th September to 31st October. The number of shares has not changed, right? I don't know how much the change is. It's not much. So maybe it's okay, but maybe it's not. So there are too many moving variables here for us to make any kind of reasonable analysis out of it. That's the issue.
Fair enough. So my question was little different. The last question, what I raised, while I accepted at the in mid of the discussion only, that attribution is probably incomplete from the perspective of the data what we get it. But extension of that question was, what is the other indicator? And that I found it missing in the answer. So if you can please throw some light on what could be other indicator which can help if we want to address the question of integrity of a particular fund manager in terms of attached to the mandate being given.
So when you say other indicator, you're saying, is there any other thing that we can look at that they are trading more than once a month?
No, so if there are any other indicators like be it, if not attribution, what could be other parameter or ratio or whatever, which can at least give us some highlight if something wrong is being done by the fund manager crossing his line in terms of managing the fund. So is there anything because at times I've seen probably turnover ratio could be one, but therein also I'm not getting satisfactory result.
Right. One thing, sir, this is very specific. You might find useful. Where if you could go to the screener and then just maybe and select let's select large cap and maybe select mid cap funds. Right. So here obviously mid cap funds should be invested in mid cap and in the columns just go to large cap, mid cap percentage. Yeah, that's right there. So here, so then what you could do is, it's a mid cap fund. Now you sort with small cap percentage or large cap also if you want. So here now you start to see some funds who have quite a lot of money in small cap, while they are called mid cap funds, right? This is one way you can kind of find that the mandate, maybe they're not sticking to as much, right? Large cap also you can do. Maybe large cap is doing really well and the mid cap fund wants to perform. So you can find some funds who've got quite a lot of money in large cap while they're marketing themselves as a mid cap. So this is one thing that we found useful, in kind of finding these issues.
If there are any other indicators or way of analyzing, please let us know in future.
Definitely, definitely.
Thanks.
Are there any more questions from anyone? So turnover ratio is currently not available. We have spoken to the data provider and we expect to have it pretty soon. Currently, it's not available in the platform.
As and when turnover ratio will be available, will you pick it up directly from the fact sheet or will there be any other source to calculate on your own? Is that
No,
possible?
sir, turnover ratio, we have to take it from the fact sheet, because in terms of to calculate turnover properly, we have to rely on the AMC to report it. There's no reason to believe that they will not give us the right number, but because obviously they are regulated. But I would say that the turnover ratio from the AMC will be the most reliable, because they obviously know their positions and how much they are churning. For us to calculate it separately, we only, as you saw, only have the monthly disclosure, so we can see how much their percentage is changing. But that's only a month-to-month change. It doesn't calculate the middle.
Thanks.
Yes. Any more questions from anyone? Okay, if there's nothing else, Amay, you can go ahead and close the call for today.
Sure. Thank you so much, everyone. And thank you for attending this session. We will be adding a couple of new updates soon in our system. So to check any updates, you can actually go ahead to this tab called updates. It is actually a Twitter feed, so you can also follow us on Twitter if you want. So we are actually adding insights, which are a new functionality which you can share on the Twitter. And also another thing is we have also got settings tab. So if any point of the time you face any difficulties regarding your details or the colors, if you want to change the colors of your reports or even the platform, you can easily do that in the settings. And one important thing in the settings here is the single security analysis and portfolio analytics. So if you want to set a singular start date, let's say my criteria is always to start with 2014, so I can just keep it as 2014 and it will start for any fund as of any particular fund which I, and even in the section I could choose to either have BSE and NSE, and you can also have this general tab which helps you to preset your analysis in our system. So that's basically it for today. Thank you so much, everyone, and have a nice weekend. We will catch up in the next week, Friday, 4 o'clock, same time. And thank you, everyone.